All right, we're going to go ahead and start. I know there may be folks coming in a little later, so we have a lot to discuss, so I think it makes sense to go ahead and start right now. Well, good afternoon, everyone. On behalf of the Illinois Power Agency, I'd like to invite you all to the Power Hour webinar on understanding electricity prices, trends, and tools in the US and Illinois. My name is Megha Hamal. I am the Chief Strategy and Communications Officer for the Illinois Power Agency, and I will be your host today. Special thanks to our IPA Communications Specialist, Tori Tartaglia, for handling logistics and supporting the webinar. To get started, let's go over some housekeeping items. All participants are muted upon entry to avoid any background noise. Please feel free to submit questions at any time using the chat feature at the bottom of the Zoom window. We will spend about 10 minutes at the end to take your questions. Please note that today's session is being recorded, and a recorded version of this session will be available on the IPA website. The agency has determined that use of artificial intelligence note-taking tools will not be permitted in this webinar. The agency will remove AI note takers from the meeting, so thank you for your understanding and cooperation. Next slide, Tori. Great. So we are really thrilled by the response to this session. We had about 200 registrants registered for this webinar. It is clear that there is a strong and growing interest on this topic, especially as electricity prices and market dynamics continue to evolve. We hope that this webinar sheds light on what makes up electricity prices, what's driving changes right now, and where things may be headed. Before we begin, a few quick notes. This webinar is intended for general education purposes only and does not represent a legal interpretation or statement of policy by the IPA or its staff. Additionally, this forum is not intended for discussing items currently under petition or legal proceedings, as those fall under ex parte communication rules. And finally, if you are interested in accessing our previous webinars on a wide range of clean energy issues and topics, please visit the IPA website and click Events. With that, let's get started and introduce our speakers for today. Next slide, Tori. Thank you. Our first speaker is Jim Rouland, IPA Planning and Procurement Chief. In this role, he oversees competitive procurements for new utility-scale wind, solar, and brownfield site solar project development, along with the recent addition of utility-scale energy storage. He also oversees the management of IPA's solar incentive programs, including Illinois Shines and Illinois Solar for All. Jim has over 21 years of comprehensive experience in the energy sector, working across both regulated and deregulated markets. He has deep expertise in wholesale and retail energy procurement, renewable energy development, transmission and distribution rate making and tariff development, and customer program design. Welcome, Jim. Our next speaker is Will Gorman, research scientist at Lawrence Berkeley National Laboratory. His work focuses on the interconnection of new supply into the electric power system, retail electricity prices, and the application of energy storage within electricity systems. He also co-authored the white paper on factors influencing recent retail electricity price trends, which was published in Science Direct. Welcome, Will. And our final speaker is Nate Miller, Senior Director of Energy and Environmental Economics, also known as E3. In his work, Nate supports public and private sector clients across the U.S. with market forecasting and analysis, strategy, resource planning, procurement, and investment decisions with a focus on the energy transition. E3 was a key collaborator on the 2025 Resource Adequacy Study. Welcome, Nate. Now, I would like to welcome Jim to kick off today's presentation. He will be providing a high-level overview of electricity pricing. Jim, the floor is yours.
Thanks, Mega. And welcome everyone. As Mega said, I'm the Planning and Procurement Bureau Chief here at the IPA. And Tori, why don't we move right to the second slide? So what I'm going to try to do here is provide a very high-level overview of some of the key components of energy pricing, electricity pricing, that'll really help provide some governance as we go into Will and Nate's presentations. Then I'll bookend at the end some of the IPA programs and processes here. So I wanted to start with just giving the visual that you can kind of ingrain in your brain, and there's probably pieces that all of you will know and be more comfortable with, from the left side of the screen with the generation aspect to the customer usage and demand side on the right side of the screen, and then all the pieces that are between. You have the substations, the transmission grid. I'm showing kind of a little bit of the wires, and mostly the towers. You have, again, some smaller level substations, distribution pole, the pole attachments, transformer, all of these things. There's a lot of pieces that go from end to end from what a customer needs, whomever that customer is, and then the resources that help provide that value. So you can kind of keep this in your mind as we go. I'm going to break down some of the pieces, and you should be pretty easily able to identify what parts go with what. So if we move on to the next slide, what I'm trying to do here is really break down in the simplest terms possible the key components that roll up to electricity prices. We could spend hours, days talking about the nuanced components here, if just with energy only, let alone capacity and transmission distribution. But if you take that step back and you say, okay, we have an electricity price, you could all look at your bills, or you could look at some of the components in the market you may have read about or maybe are actively participating in. It functionally breaks down to really these four elements: energy, that is how much you use or consume as a consumer; the capacity, which is really the cost of the price mechanic for reliability to make sure resources are there when you need them, how you need them, and that's often during grid constraints. It could be outages, be it weather or otherwise, just high demand days. It's that component that says we need that resource over a period of time. Typically, it's over a year, that we'll talk about in a little bit. And then you have, and all of that, to maybe stop there, is often generation focused. It's meeting customer needs. You don't need generation if you don't have a need for customer usage, that is electricity usage. They're typically combined together, and they're often thought of together. They're different parts, they're different markets, but they're often focused on that generation aspect. And then you have the connector to the customers. That's the transmission distribution grid. Transmission is delivering power across long distances, typically high voltage. Distribution is your local delivery. And there's connectors behind that. And so, really, from an end to end, you could break a lot of the key components, or at least group them by one of these four categories. And in some cases, they're overlapping, but one of these four. I did put on the screen this catch-all other components. I'm sure many of you were thinking, well, there's customer programs, there's market ancillary markets and services, there's specialty components and programs. Yes, they all exist too. They often overlap depending on the group, on the topic. In some cases, they're distribution focused and they might be embedded in that bill or that rate component, be it, let's just say, a utility program for energy efficiency, or there could be a market component that's an ancillary market that we're not going to get into detail today, but just know that they're there. They're often embedded within some of these key components, and they're usually a smaller piece. They're a buttress. There's something that's there to help reinforce a component through one of these four, if not more. So moving on to the next slide, what I really wanted to go through here is say, okay, we know that there's these four components. We know there's energy, electricity, capacity, transmission, distribution. But what's that mean across the spectrum of who's playing what role? And so we're going to start with the manages, that is, oversees the process, in some cases, the development, who regulates by and large, and then who informs. And I'll talk about informing because that one can be pretty dynamic depending on the topic. So, from a management perspective, let's just start with the generation. So, electricity and capacity. Typically, the RTO manages the market. They don't own the assets. They don't bid into the assets. They don't kind of have the front or the back. They manage the middle, and that middle is the market itself and the design formation itself. They're overseen by FERC, Federal Energy Regulatory Commission. FERC ensures that PJM and MISO, our RTOs, or regional transmission organizations, manage things appropriately, that they're implementing statute and law and regulation appropriately at that level. But ultimately, the RTOs, the PJM and the MISOs, are helping to kind of manage the market. And then in this case, the informers, those that provide either information or data. You could get into a lot of nuance here, but I picked the big ones, which are generators and customer usage or customers. Generators are on the one end of it. They're trying to say for energy, what am I willing to operate at? What am I bidding into the PJM and MISO markets at to operate and meet customer demand and usage? And then the customers are on the other end. They're that instantaneous demand from the market. And then for capacity, different spectrum, different time horizon, but same concept. It's RTOs managing the design and evaluation and forecast of what they think demand is going to be over periods of time, what reliability standards they're trying to set and achieve. Generators are bidding into the RTO's auctions. They're providing opportunity of their resource into that auction. And then customer demand is informing how the demand over periods of time are going to go. So, more customers coming on or customers leaving, as the case may be, is going to adjust what the ongoing forecast for the RTOs who are setting up this market are. Transmission and distribution are similar but slightly different in really the frame. So transmission managed by the developer, and I put developer instead of utility. In many instances, it's the utility, the local utility, the Ameren, Illinois, the ComEd, the Mid-American, and so on that have the assets in their service territory that you might think of and be a customer of. But there's other entities that are actively participating in the space too. The merchant transmission developers that really are just in the business of transmission build. You even have some generators starting to get into the space where they own small pieces of, say, interconnection or build out to help with their assets. So you have these developers, and I put PJM and MISO here, not because they own the assets, but because they also manage a market. And there is a market for some of these through a competitive kind of auction process for transmission. PJM, it's called RTEP, the Regional Transmission Expansion Program or process. And the way that this really works is there's again a need that's managed or necessary for, to say, increased demand or generation interconnection. And PJM's managing that process to facilitate these assets to come on or to build out. Again, it's overseen typically and by and large by FERC. But then you have a lot of informers in this. And when you get down to these levels, the informers only increase generators who want the connection or need the connection to have their power reach the demand locations. Customers who I put here who have the demand, have the need. I put the ICC here in that there are siting and permitting requirements at a state level. There's certain oversights that are needed. It's not at the same regulatory level as FERC from a RTO or a federal standpoint, but there are absolutely aspects that are part of this process. And then you have advocacy groups as well for different needs and demands and expectations, recommendations. Distribution's very complementary, but just the next level down. Local utilities manage that. They own and operate their local distribution grids. In this case, the commission, the ICC, regulates this process as well. And then you have a lot of the same players, maybe just at the next rung down. So you again have customer demand that the utilities are trying to build their assets to support, advocacy groups to support it, maybe even some small generators here or there. This goes beyond the behind the meter generation that I think kind of links with the customers, but you could also kind of group in here. So there's a lot of different players throughout this. And moving on to the last slide, and I kind of really want to move on here more so because I think Will and Nate's presentations are going to go into a lot more detail, but it's to bring it back home. The end of the day, if you take what I just spoke about for the past, say, 7 or 8 minutes, it comes down to the energy markets and these costs are directly and directionally informed by cause and effect. And many of you may go, well, obviously. But when you look at these pieces, it's energy prices, customers have a demand for instantaneous needs. Generators are trying to submit offers to meet those needs. The market is managed by the RTOs ultimately to create a cost of serving demand for specific time and specific locations. And you can walk through each of these and they follow a very similar pattern. Capacity, same thing. Demand needed, it relates then to the RTO markets for and auctions to set the pricing for that. Transmission and distribution, both overseen by FERC and ICC processes respectively, ultimately driven by the need for investment to either build out, to reinforce, to support customer demands, and often linking on the transmission side the generation assets. So if you kind of walk away and look at the full picture here, it's an end to end where we started of the four major segments and then a reiteration of them of the cause and then the ultimate effect. So with that, I can hand it back to Mega to continue on our conversation here.
Thank you, Jim. At this time, I would like to welcome Will to go over factors impacting electricity prices nationwide. Will, the floor is yours.
Great. Thanks, Mega. Thanks for inviting me to speak today. So, hello, everyone. My name is Will Gorman, research scientist, as Mega mentioned, at LBNL. I'm going to be talking about an annual report we've now been doing for about a year, but we have two iterations of it. And so I'm going to be talking about the latest iteration. There was a big co-author team involved here. I'm not going to speak the names out loud. You can see those folks here, but this was a pretty big team effort. Let's go to the next slide where I'll provide some context about what I'll be talking about. So the context and motivation of our work to try to understand retail electricity prices is that retail electricity prices have been increasing nationally, and they've been increasing in concert with economy-wide inflation. But there is significant differences among states. And so our goal with this work was really to try to add nuance to perhaps the newspaper headlines that you sometimes read that describe what is quote unquote a national electricity affordability crisis. So we wanted to add some nuance to that. And we think that nuance is important because if it is not there, oftentimes there can be scapegoating to identify, your target driver for what is causing this quote unquote crisis. So the study scope here, I want to be clear, this is a historical analysis. This is not a forecast of what is going to happen into the future. And so what we're really doing is summarizing recent retail electricity prices nationally, as well as some state level price trends, usually going back to 2010 or 2019. And then we also are trying to assess the drivers of those recent changes to retail electricity prices, usually going back only to 2019, but looking at the 2019 to 2025 period, in part because that is really where we've started to see increases in prices. One other last scoping point is that Illinois will show up on some of these slides. MISO and PJM will show up on some of these slides, and I will try to highlight them, but I'm mainly trying to give a national storyline here and let Jim and Nate do some of the heavy lifting to talk about Illinois specific details. So just a note that this really is national in scope. All right, next slide. Okay, so I'm going to first start with just level setting on national and some state level trends with historical data. So next slide, Tori. So the first point is, as I have already said, national average nominal retail prices have spiked in recent years. That is the orange line on this graphic. However, once you adjust those prices for inflation, which is what you see in the blue line, retail prices are actually lower than they were in 2010, though there was a slight bump and uptick in 2025. Whether or not that is a longer term trend that is going to continue into the future, it's unclear. But I think it's hard when you look at a graphic like this to identify a national electricity affordability crisis. Next slide, Tori. Another way to maybe validate the last sentence I just said is we can compare the residential electricity costs in the United States as a percentage of personal consumption expenditures. So how much households are spending. That is what you see in the chart on the left, the blue line. We can also do this as a residential electricity cost as a percentage of personal income. That's the chart on the right. Both of these metrics try to give some flavor for how much people are spending relative to income and other things on electricity. And those are at all-time lows. Certainly, when you go back to 2010, you see the decline here. We've also gone back more decades than this. So again, when you look at some of these macroeconomic big picture metrics, hard to identify a national affordability crisis storyline. Go to the next slide. But of course, I don't pay a national electricity price. You certainly don't pay a national electricity price. People pay the tariffs that their utility set forth. And there is a lot of heterogeneity when you look at different utilities in different states. And so that's what this chart on the right is meant to convey. These are average changes in real prices across the United States from 2019 to 25. California, where I sit, has seen some of the largest, if you look at a state level basis, increases in prices. Places in the Northeast have as well. You also see Illinois show up on this map. Not certainly as bad as maybe New York, Maine, California, but prices have gone up. And so there are state level increases in prices. And then the last point I want to make is also regardless of national trends, or even some of those personal consumption expenditure data that I showed on the previous slide, there is a distribution of people in this country with different incomes. And a third of households, we would say, have electricity-only burdens greater than 5%, which usually is seen as a fairly large fraction of your income going to pay for electricity bills. So while stating that there is a national electricity affordability crisis, I think is a bridge too far, there's no doubt that certain places in this country and certain people in this country can be struggling. Next slide. So now let's try to understand that state level variation that I just showed you on the previous slide. So in the next, I'm going to bop through a number of slides really quickly here to kind of keep us on time. So I apologize in advance, happy to answer questions, but these next 10 slides are going to talk about key drivers of these changes and the heterogeneity. And the first slide here is focusing on distribution costs. So Jim mentioned these as costs mostly controlled by local utilities. Infrastructure spending has increased since 2014, rising 4 times faster in real dollars. And so what this chart on the right shows are different regions of the country. You can find PJM and MISO on this chart. PJM and MISO actually are regions that have not seen distribution be a big cost driver. So the bar color notates whether it's a 2019 cost or a 2025 cost. And so you can see where this has really been a big impact is where I live in California. That's CAISO, huge increase in distribution expenditures. Increases in New York as well, and ISO New England. I mean, some small increases in other regions as well, but not as big as in CAISO New York and ISO New England. And if you remember on my slide 2 slides ago where I saw the state level variation, California, New York, and New England, some of the places that have seen the biggest increases. So distribution, a critical component there. You go to the next slide. We also wanted to do this breakout for the transmission component of retail prices. And so what you can also see here is the different regions of the country, prices also going up in New England, California, also going up a little bit in PJM, but not going up as much in MISO, SPP, and ERCOT. So this is also a component of the variation, not as dramatic as distribution costs, but certainly an important thing to be tracking. Next slide. So there's a question of, okay, well, why are these costs going up? Well, one thing is that we are doing more T&D investment, and that's driven by asset replacement, grid hardening, grid expansion. But we're also doing it at a time when the cost for the key materials has dramatically outpaced inflation. So that's what this chart on the right is meant to convey. You can see inflation in the dotted black line, which is at the very bottom of this chart, and all of the components, electrical components that make up a transmission and distribution system the price of those components far outpacing inflation. So that is a challenge here. Next slide. Another thing I mentioned, and I don't expect you to process all of the stuff that is in these charts, but we looked at wildfire mitigation costs, which is the chart on the right, and storm recovery costs, which is the chart on the left. And these are important drivers for specific regions in the country. Wildfire mitigations are no doubt the most important driver of why I have been paying almost 2 times more for electricity than I had 6 years ago in California. The investor-owned utilities in California have spent a lot of money in this area. And these are long-term, recurring, ongoing investments. Storm recovery are usually more reactive investments, system repairs after a hurricane, so they're a little bit more one-off, but can have a big impact, especially in the eastern states and the Gulf Coast states. Next slide. State policies can also require or encourage wind and solar deployment above what a competitive market might deliver have also increased prices. So we look at renewable portfolio standard compliance costs, again, historically from 2019 to 2025. And what this chart on the left shows is the compliance costs for those RPS programs in different states. You can see Illinois in the middle of this chart. Historical compliance costs certainly are not meant to project what they will be in the future, but this is what we've seen historically. But places like New Jersey, Maine, Rhode Island, they've seen larger compliance costs. Net energy metering, so the prices we pay for rooftop solar or the credits we give for rooftop solar also have an impact. But they only have an impact in states that have seen high penetrations of rooftop solar, and that's not many states in this country. So where that has happened in California, Maine, we do see high impacts in California as high as 2 cents a kilowatt hour, but the penetration is just not as high in other regions. Next slide. But we also looked at market-based wind and solar deployment. So if you go to the chart on the right, what this is showing on the x-axis is the growth in wind and solar in a given state, and the y-axis shows the retail price change. You can see not a lot of correlation. As you go further to the right, you actually see in South Dakota, New Mexico, Iowa, actually lower retail prices. But in general, our statistical analysis just shows no correlation. So RPS policies are kind of a separate thing to think about versus just general growth in wind and solar. Next slide. Just two more slides, I think, on drivers. Wholesale prices, so thinking about those generation costs that Jim mentioned, are strongly correlated with natural gas prices. Over the medium run, that's been a good news story with the rise of shale gas. Gas prices have come down, wholesale market prices have come down with that. But gas prices are also volatile. And so what this chart shows in 2022, for instance, on the onset of the Ukraine-Russia war, wholesale market prices in the US jumped up when natural gas prices jumped up, and we saw those impact retail prices around 2 cents a kilowatt hour. And in some states, greater than 4 cents a kilowatt hour, especially in New England, which is particularly exposed to the volatility of the gas market. So that is also an important driver. Next slide. So the last thing that I'll note here, this is probably the most controversial of our findings, is that when we look at load growth at the state level, states that have seen the most load growth over the last 6 years tended to see the lowest retail electricity prices. Now, we want to be clear, it is unclear to what degree this will hold into the future. You actually really only have to look to the PJM capacity market to see that load growth, or at least expectations of load growth and how the capacity market dynamics play out, have led to increases in prices. But it is still an interesting finding to see places like North Dakota, which maybe had a lot of spare capacity or incremental headroom. They were able to integrate a lot of new load and lower all-in prices because of it. And so there are case studies out there for places that have been able to do this successfully. Uh, Next slide. So just two things to give you a little bit of flavor of what might be coming down the pike. Two more slides, 2 points I want to make. So next slide, Tori. The first is, so I was focused mostly on medium-term trends, 2019 to 2025. But what just happened last year? What happened between 2024 and 2025? The first thing to note, and I mentioned this earlier in my presentation, is that over the last year, prices have outpaced inflation. That was the bump in 2025 I mentioned. And you can see, maybe the disease is spreading. There's a lot more red in this chart than in the previous state chart, meaning many states did see price increases from 2024 to 2025. This other graph that I show you here are what are the primary drivers of those price changes over the last year? And a lot of it is fuel and wholesale supply. Natural gas prices did go up in this period. This is an important driver, as I mentioned before. So there is some volatility here. I think there's some question of what's going to happen in the future. I'm not trying to predict gas prices. That's not what I'm in the business of doing. Other people are in the business of doing that. But also distribution costs, generation CapEx, transmission costs, those other key drivers that I mentioned earlier did have a role in 2024 to 2024 price change, 2025 price changes, but just not as much as fuel and wholesale supply. Then last slide for me here, we have tracked investor-owned utility rate change requests. Those are at all-time highs, all-time multi-decadal highs. You basically have to go back to the 1980s. At the same time, we've also seen Public Utility Commission approvals at all-time highs. That's what the chart on the right is meant to convey. And so when you have high levels of requests, high levels of approvals, that is suggestive of at least near-term price increases. So we do expect prices to continue to go up based on these data, but for how long, I think is very unclear. So I think I'll stop there. All this material is public, by the way. I know I went through this really quickly. This is all online. You can kind of read it in your own time, but I just wanted to give a flavor for some of the work that we've done. But I'll turn it back to Mega, and then Tori, you can skip, I think, 6 or 7 slides to get to Nate's stuff. Just wanted to save time for him.
Thank you, Will. Appreciate it. At this time, I would like to welcome Nate from E3 Senior Director to dive into electricity pricing in Illinois and the Midwest. Nate, the floor is yours.
Thanks, Mecca. Just making sure my microphone is coming through. Great. Let's go to the next slide. The objective here is to spend just a few minutes taking some of those broad, big picture trends in terms of the structure of cost that Jim talked about and some of the historical drivers that Will talked about, and then make them a bit more local and specific to Illinois and the regional markets, MISO and PJM, that Illinois is part of. So I'm going to cover 3 principal questions here. Number 1, kind of what are the components of electricity costs, kind of focused on a customer bill that you all might be more familiar with if you live in Illinois. What's driving the supply cost portion of that bill? And we'll talk a bit more about what that is, and then some factors driving it over the last few years. And then ultimately end with what is the state of Illinois doing about all of this? And at that point, I'll pass it back to Jim. So let's page forward here and just talk about, it's going to be a quick recap of what Jim has said, but then we're going to take this another level deeper. So as you'll see, whether you live in the Ameren or ComEd service territories or Mid-American and Illinois, you'll see 3 principal components or categories of costs on your monthly electric bill. You've got your supply, your delivery, and then your taxes and programs or taxes and fees. On the supply cost, that's actually inclusive of sort of the generation cost and the transmission costs overall. And oftentimes those components will be broken out separately as different line items in your bill. Generation being the cost to produce electricity from power plants on the grid, and then the transmission being the cost of delivering that electricity over the high voltage network to the local utilities distribution network. Delivery is then just the distribution portion of that cost. So taking it from the freeway down the off-ramp to your house, right? And then the taxes and programs that you'll see would be kind of everything else that's part of your bill. That includes state and local taxes, and then all the different ratepayer funded programs that the state of Illinois has. Those include energy efficiency, behind the meter solar, and the state's renewable energy procurements. So if we go forward, We're going to talk about each one of these in a little bit more detail. So first, let's talk about supply. So just want to level set everyone that Illinois is a part of these two broad regional grids, MISO and PJM, and that means that the supply of electricity is actually integrated in a large grid and a market. That market in PJM and MISO settles prices at individual locations in the entire footprint. PJM covers from New Jersey and Maryland and the Atlantic and DC all the way out to Chicago. And of course, MISO, covers a large north to south segment from Louisiana all the way in the south to, Minnesota all the way in the north and Wisconsin. So at that point, looking at these markets, the energy prices that everyone in Illinois pays are set by market prices. Those market prices, we'll dive into that in a moment, include energy market prices, capacity market prices, which is the price of reliability, and then some ancillary services and grid balancing, so a bundle of other costs and services that the grid needs to operate. Now, suppliers in Illinois, and there are three principal kinds of suppliers I'll talk about in a moment, they can choose how to manage the cost of supply, but all suppliers ultimately pay the market prices that are happening every minute of every day. And in these markets, most of the prices are settled on an hourly level. And there are also every 5 minutes at different locations, there are different prices. And then, of course, the transmission charge, that delivery charge across the high voltage network, is based on rates that are regulated by the Federal Energy Regulatory Commission, or FERC. So let's look at the different kinds of service providers that you all receive service from in Illinois. First of all, there's the default service. That's if you take your service from the utilities, ComEd, Ameren, and MidAmerican. If you are a customer taking default service for the supply portion of your bill, you're actually getting supply that is bought and hedged, managed for you by the Illinois Power Agency, and Jim could talk all about that. And we 83 have been supporting the IPA with its work over the last year. The IPA manages the cost and the risk of that cost through short-term contracts for power and capacity for the MISO zone for customers under default service. Now, if you're not a default service customer, especially all large industrial customers are not default service, they take their supply from alternative retail electric service, or ARES, providers in Illinois. Different residences can choose also to take their supply from an ARES rather than from the default service of the utility. And these electric suppliers they do their own management of the cost of supply. They can set their own prices, and they compete for one another, against one another for customers. They can actually deliver power and manage the cost of that power by their owned power plants, contracts with power generators, financial hedges, or just market purchases. And then finally, we have municipal utilities and electric cooperatives in Illinois. And these would be, some cities have their own local utilities, and same with electric cooperatives. Some of them own their own power plants. But oftentimes they will contract with an ARES, an alternative supply company, to manage their cost of power for customers. And in fact, most of the residential customers who in Illinois who are receiving supply service from an alternative supplier are receiving that through a municipal utility. Let's go to the next slide. So now we've talked about supply. We have a couple different entities managing the cost of that energy and capacity on behalf of customers, but let's talk about delivery. That's the network charge. And this is a little bit different because the service territories for distribution of ComEd, Ameren, and MidAmerican that cover the vast majority of customers in the state, those utilities own those distribution networks, and they've built those networks over time, and the cost of those networks provided to customers is a regulated cost of service. And it's regulated by the Illinois Commerce Commission through periodic rate cases. In Illinois, these rate cases happen every 4 years. And so everyone, whether you're on an ARES supply or a default service, is paying the same delivery charge that's regulated through rate cases on the network of these utilities, unless you are a member of a municipal utility or an electric cooperative that owns their own distribution network. And there are a few of these in Illinois. But by and large, most customers pay this regulated rate. And again, it's based on cost of service. So what is the cost of service? Cost of service includes, as Will was talking about, the capital investment ongoing to build and maintain the wires and the poles and all the other components of the grid at the local level. It is also driven by the cost of capital, cost of financing, and operations and maintenance, including metering and billing and other administrative expenses. So the next slide here, we'll talk about taxes and programs. Everyone's favorite topic is taxes, of course. There are just two kinds of taxes, and they're relatively small here. We've got state taxes and municipal taxes. Municipal taxes, of course, are set by individual municipalities in Illinois and can vary from location to location. And then state taxes, there are certain state taxes on the rights of way that are used for the transmission distribution network. And they're relatively limited. Most of this category is going to be on the programs side. And the programs and really include the renewable energy program, the customer solar programs, all of them are under the same cost bucket here for customers. Then energy efficiency programs as well that ratepayers pay into, and the funds from those programs are used to provide energy efficiency incentives to other customers. And then you also have a number of other programs, including the Energy Transition Assistance, which is a CJO Workforce and Community Development Program. And then you have some environmental mitigation costs collections specifically for certain utilities. So let's go forward and we're going to take a deeper look at some illustrative bills. So obviously there are a number of different rates in Illinois, a number of different consumption patterns and customer types. This is just an illustration of the broad components that we've seen over the last few years for residential customers. These would be default service customers. We're assuming that we're consuming about 750 kilowatt hours a month. This is an annualized monthly bill. So again, this is meant to show the kind of relative breakdown and comparison. This is not meant to be anything definitive, right? Because there is a lot of nuance when we end up with specific customer rates and consumption patterns and costs. So with that in mind, we can see that overall supply charges, the generation and transmission of power for customers, for residential customers are about 50% of the total bill. And after that 50%, then we have delivery charges as the next major component of the bill, and then a very small component of the bill relatively are the taxes and program fees. And so we can look at a broad trend over time here in general, which is that if you look at the darkest shade of both the Ameren service territory and ComEd service territory bills, we can see that between 2023 and 24, the supply charge declined in Ameren and in ComEd, but then the supply charges have increased over the last couple of years. 2026 here is illustrative. We don't have final price to compare rates for the summer yet. So just again, this is meant to be an illustration here. Similarly speaking, we can see that, to Will's point, delivery charges have also been increasing recently in Illinois. So if we go to the next slide, we're going to focus a little bit further on the supply components. So I want to first say, I mean, we think about Illinois in general and Chicago, the crossroads of America. It really is actually right in the middle of a lot of big changes and challenges that are happening in the national U.S. electricity sector today. So we've got Illinois here, and you can see the market footprints of MISO in blue and PJM off to the right. And these large markets, you can see how Illinois has these portions of the state, the Chicago area and the surrounding, and the southern Illinois and Ameren's territory span these two different markets. But what's happening in the broad sector today, we could spend way too much time talking about this, but really we have a confluence of very challenging effects. We have an aging power system where transmission lines, distribution lines, and old thermal power plants, thermal meaning burning a fossil fuel to generate power, all need to be replaced over time, and that has costs. But at the same time, we have load growth, not just from regular customers and population factors, but large loads, including data centers, especially in these two markets. And at the same time, the combination of thermal plant retirements and load growth creates both summer and winter reliability risk. And that also has an effect. Those are amplified by recent observed weather risks that we've seen for winter storms and summer heat waves. So with that increasing reliability challenge, we also have the changing evolution of the grid in terms of where power plants are located and how consumers are consuming energy. EVs and building electrification, heat pumps, even more air conditioning for summer that homes didn't maybe have as much before. All of that is changing the load profile of even residential customers. And at the same time, distributed energy resources are having an effect upon distribution networks and those changes. And then, of course, we have decarbonization goals across different states and localities. So we're going to step through how some of these factors have manifested in specific supply costs for Illinois recently. So the next slide here is going to take a look at just energy prices. So what you're looking at is a graph of the wholesale market prices in the Ameren and the ComEd zone. So Ameren is the MISO zone 4, and ComEd is the name of the PJM zone for that service territory. And what we can see here, these are average monthly prices, just simple average monthly prices, and they're actually hourly prices that have been averaged up. And over time, a couple things to call out. So one, you can see that in 2025, the annual average price levels are higher by a decent amount than the previous 2 years. That's largely because gas prices have increased over this time period. But you can also see pretty significant seasonal variation in prices. This is why your summer price is higher than your non-summer price in Illinois, right? And it's because summers take a lot of power demand. There's a lot of AC loads on. And so you need more power generation, which means you have to call in more power plants that have higher costs to serve. And that's the reason why those prices are higher. But at the same time, winter prices usually increase each year, as you've seen a continual trend over the last 3 years. And if we go to the next slide, we'll dig a little bit deeper about what's been happening with power prices from gas. I mean, as Will correctly called out, natural gas is the principal source of generation that is setting electricity prices in most markets, including in MISO and PJM. And you can see that the Illinois delivered gas price, this is from the EIA price delivered to power producers in Illinois, is highly related to the shape of the electricity prices that you're seeing. So why is that? I'll cover just a moment here. Um, Energy prices, the way energy markets work, is they're driven by the short run marginal cost of power from the most expensive plant needed in a given hour to meet demand. In other words, the last plant that is dispatched, that's called upon to generate, to serve the last bit of power demand in any given hour. And that plant's always the most expensive because you want to start with the cheapest plants first and then layer on until you get to where you need to go. So in most hours, that cost, that short run marginal cost, is the cost of burning natural gas at the plant's efficiency rate. So it's the fuel cost, as well as some additional variable costs that the plant has. And so power plant heat rates, or the fuel efficiency, and the gas prices together are the biggest drivers of electricity prices in the US. Now, that means kind of two things, and I want to leave you all with this, is that high demand hours require a greater stack of power generation, which again has the more expensive plants at the top, and that tends to increase the price, all else equal, during high demand hours. Those typically occur in the summer in Illinois. But at the same time, gas prices can also have a big impact, and that's what's driving winter prices in Illinois. It's actually that gas prices rise with heating demand in the winter for all gas, not just in the power sector, and that keeps the gas price high. That's what happens in New England and New York as well. And so you have this trade-off where summer prices are high because load is high, and winter prices are high because fuel prices are more expensive. So let's step forward, and now we're going to talk about a few other items before we close out here. So let's talk about capacity. If you've been looking at the news, I mean, most of the time power prices don't show up in the news at all. That's when times are pretty normal and easy. But power prices, especially capacity markets, have been showing up in the news. And I think a lot of folks reasonably ask, well, what even is a capacity market? We don't have time to go into a lot of depth here, but I wanted to just kind of set some framing of what's going on. So a capacity market, MISO and PJM are responsible for the reliability of these big regional grids. And the way they do that, one of the ways they do that, is they operate markets to pay generators for their reliability contribution during critical hours where the grid is at risk, where the grid has the most challenge to serve load. And so everyone participates, all loads and generators participate in these markets, generally speaking. There are some exceptions, but we won't need to cover them here. And customers are paying for their share of the grid's peak needs, peak demand needs during those times. And they're paying for that share in megawatts at the auction price. Now, as we talked earlier, there are different kinds of suppliers that manage cost. there are different ways to manage costs. You can contract with a generator instead of paying the auction price, and that's a risk decision. If you own your own generation, that generation counts towards your obligation in these capacity auctions. So different ways to manage these prices. But here you can see what's happening is that these reliability prices have gone up dramatically very quickly in the last few years. So what you're looking at on the right is a chart of the final annual clearing prices of the MISO and the PJM capacity auctions. So you can see that MISO in 2022 to 2023, they have these split delivery years that they use at a pretty high price actually, but then it dropped dramatically for the next 2 years. And then in the 2025 to 2026, the most recent delivery year, that price came all the way back up. And we're about to get new auction results for the 26-27 delivery year that haven't quite dropped yet. In PJM, that's where a lot of the headlines have been. We've had a long period of very low capacity prices. And starting in the 2025 to 26 delivery year, we've seen 3 successive auctions where the price has gone ever higher. And something else to call out here on the right-hand side is there has been a cap, price cap in the PJM auction from a complaint filed by Governor Shapiro in Pennsylvania and then litigated through FERC. And that cap has been in effect for the last 2 auctions. PJM estimated that without the cap, prices would be at the level shown here, which especially in the latest auction, the 2027 to 2028 auction, would have been significantly higher if not for the price cap. So what that indicates is that indicates a very real and emerging reliability need for new generation to serve and maintain reliability in these markets. Now, the last thing I want to note, and we'll get into what is Illinois doing about this, is that last year, the Illinois state agencies, the ICC, the IPA, and the IEPA, completed the first Resource Adequacy Study that was directed for the agencies to complete by CEJA, and I and E3 supported the agencies in the creation of that study. It was published in December and analyzed the reliability challenge facing Illinois and the broader markets. And it concluded that these reliability risks will continue to affect Illinois in coming years, and that has kicked off some work this year. So I will use just the next couple minutes to talk about what's happening there and then hand it back off to Mega and Jim. So the next slide. All right, very briefly, the big picture, and this is directly from the Resource Adequacy Study, which is a public study and can be found on the IPA's website. We see that load growth, the reliability need, is increasing significantly in these broader regions and in the Illinois zones in these regions, which is the bottom part of this chart, over the next 10 years and beyond. The next slide. In addition to load growth, we also have thermal retirement, so coal and gas capacity that provides a lot of reliability. These plants are also very old, and those plants in PJM and MISO, there are a lot of plants scheduled to retire over the next 10 years. Now, those retirement dates may move around a little bit, and plant owners can make different decisions, but they're always balancing how much do I have to invest in this plant to keep it operating, what's safe to keep it operating, and what's the plant worth in the market. And so that's always a constant calibration. But suffice to say that whether those plants retire tomorrow, the day after tomorrow, or some years from now, there is going to be a date at which a lot of this capacity that was installed in the 60s, 70s, and 80s is going to have to retire. So the next slide. And so now let's look at, well, what's being added to the grid at the same time as the coal and gas units. Not all of them, but a good portion of them are slated to retire. Mostly what's being added is wind and solar and storage. And one of the issues is wind and solar and storage have a lot of benefits, but they also have some challenges in that they don't all provide the same reliability value that a fueled power plant does. A fueled power plant, you can feed fuel to it and turn it on and it generates during a winter condition. Doesn't matter if the sun's out or the wind's blowing. And batteries have limited duration of how much power they can store, and you can buy longer and longer durations, but they don't generate power, right? They just move power from one time to another time. And so if you look at on the left, this is all the sum total of resources at the time of the study that were currently in development in PJM and MISO. You had 65 gigawatts or so and 80 gigawatts in PJM. But when you translate those to effective, reliable megawatts, like for the capacity needs of the market, there's a significant D rate. and the 65 becomes roughly 27 in MISO, and the 80 becomes roughly 22 in PJM. And so you've got like that alone is about the load growth that you had, or just the retirements, but not both. And that's one of the key issues facing these markets. Next slide. So when you put that picture together, you end up with kind of where the RA study ended up, which is you have a range of outcomes where maybe you could delay some retirements, which improves the reliability situation, or you could face the issue that some of these resource additions may be delayed, which would worsen the reliability situation. When you look at that range of risk, and this is all documented in the RA study, on the right-hand side, this is the range of additional megawatt needs that the market needs to maintain its same reliability standard. We see that in, as early as 2028 in PJM, or 2029 in MISO, and certainly well into the 2030s, we see a range of additional needs on the order of, maybe 10 or more gigawatts in PJM, in the order of, 5 to 10 or more in MISO. And so when you look at that, one way to calibrate our findings is PJM's latest auction for the 2027-28 delivery year was 6.6 gigawatts short, which is kind of right in the middle of the delay scenario range that we estimated for the RA study. So just another validation point that this kind of is where the market's at today, and there's a need to bring new capacity online at the same time as other system changes are taking place. So let's go forward. So what's the state of Illinois doing about this? And this is where I'll hand off. Well, the state of Illinois is doing a lot about this at the moment. There's a lot of work currently in process. So first, CEJA, the Climate and Equitable Jobs Act, was passed in 2021. It set new clean energy policies and implementing mechanisms, had a whole bunch of stuff in there. It also directed state agencies to perform periodic resource adequacy studies, like the first one that was just done this last year. And if there's an RA shortfall identified, which we did in that study, then to develop a mitigation plan to address that shortfall. And then that's what the RA study did last year. That RA study feeds into a mitigation plan, which is currently in progress this year. But at the same time, the Clean and Reliable Grid Affordability Act, or CERJA, was passed in 2026, was about done at the end of last year. And CERJA adds to the state's toolkit of what to do about this. Establishes a whole bunch of new tools for planning and procurement and programs to meet the state's clean energy needs and reliability needs over time, including an integrated resource plan. That integrated resource plan, the first one for the state of Illinois here, is happening concurrently and in coordination with the mitigation plan. So there are these two broad planning exercises that E3 is supporting the state agency with. And these exercises are currently in progress. We're having stakeholder workshops, and we are studying a whole range of different options of how the state could address the challenges facing it. So at this point, I'll hand it off. Thanks.
Thank you, Nate. To round us off, I would like to invite Jim back, and he will be discussing the tools and strategies that are being used to support customers in Illinois.
Okay, thanks, Mega. And so also recognizing we're close to the end of the hour. So what I'm going to do here is focus on a few key slides. These will be posted. You can review the rest. And there's some links at the end that you can go and pull down additional information. So looking at this, I broke things into two different buckets. What's kind of active ongoing right now, literally you could go out and see information about what we're doing, how we're doing it, the opportunities and the impacts. And then the in development. The in development are effectively SERJA related, or the recent legislation passing in Illinois. They're related proposals. There are things now, they're past proposals. They're into effective work. And Nate just discussed, for example, the first one, the IRP and the resource adequacy related items. So the active and ongoing, and I'm just going to touch on really kind of one, two, and four. We'll also highlight some elements of the customer programs. But if we move to the next slide for default service and utility scale, these are the smallest, shortest bullets that you could possibly get on kind of the impact up and opportunities that are coming off of them. So default service, Nate actually talked about early. I put just down kind of a note. It's really hard sometimes to wrap your arms around, well, what is default service and how does it work and how does it impact me? Cub did some good analysis. They put out research roughly about once a year, I think, on this topic, and some of their most recent information from now a few months ago basically evaluated default service relative to competitive offerings. It's not a one size fits all. Of course, there's unique circumstances, but why I really highlighted this is, value proposition to default service customers and what we're really trying to do here at the IPA and going out to secure default service. And for the Ameren, Illinois customers, also a hedge for capacity. As Nate talked about at the end, capacity costs are going up. So we're trying our best to secure targeted supply for capacity to help hedge some of those costs and reduce some of the impact associated with them. As Nate and Will also kind of talked about across the board with different aspects that are going on for different types of generation, resources coming and going, their impact on the grid and the market. The IPA manages the index rec procurements, and this is really for utility scale, wind, solar, brownfield, PV. Just in the past few years, we've executed contracts or supported the execution of contracts for over 5 GW worth of wind and solar. That's helping to not just achieve our RPS targets and our clean energy goals, but also trying to really aid those short and kind of midterm demands for resource adequacy and ensuring we have the resources necessary to meet the needs of customers and at the most cost competitive price because these are competitive bids or competitive procurements. You can view a lot of this detail. You can see there's a diagram I pulled out. There's a lot of information on this and the pricing and locations and all sorts of things for these that I'd encourage you to go out to our website and look. If you continue to the next slide, I'm just going to quick touch on this because I'm not going to do it any service in kind of the few minutes we have here. But both Illinois Shines on this slide and the next slide, the Illinois Solar for All programs really are trying to do a few things. One is, of course, give customers the opportunity to access solar. Solar be rooftop, could be community solar, and those sorts of programs. I've highlighted for Illinois Shines here mostly just the community solar, just to target it and give you some statistics on it. But there's a lot of other opportunities it provides. It's access for customers. There are training programs. There's support networks for equity eligible persons and equity eligible contractors. There's the mentorship program on training and kind of connection opportunities. These are all through the Illinois Shine program. And if we jump to the next slide on the Solar for All, I actually took the opposite. I looked at the small DG or the small distributed generation aspect, and you can see since we've started in 2023 to where we're effectively at in 2025, you can just see the growth that we've had, just the access to these income eligible households, the nonprofits, these different public facilities and businesses that are trying to access it. It's providing support to the grassroots entities to help support their communities and to approved vendors or developers in this aspect as well. There's some amazing statistics you can look at for this as well, but it just shows the access and the reach that we're trying to provide to customers to help both enable them to get access to the solar, but also reduce some of their costs, especially with ILSFA. It's really providing that opportunity to these customers that participate, and there are a lot participating. And then on the next slide, you've probably read about some of this. Nuclear is another component, and there's a number of programs that date back some years here. This one I've highlighted as a carbon mitigation credit program for ComEd customers. It's with regards to the three nuclear facilities in that territory, the Dresden, Byron, and Braidwood. And the importance of this is that it was originally developed to help support nuclear to ensure it stays on. It provides or provided a bridge. But it provided also a further opportunity that if market costs go up and what the nuclear facilities are able to obtain through the market has gone up, there's benefits fed back to customers. And what you can see here in a word is substantial benefit back to customers through credits. And many in the ComEd territory should be seeing this literally on your bill where the market prices are going up, and in that case, there is increased demand and cost to you as a customer. But there are also mitigation factors that we have here, and this is one of them, the CMC, that's providing value back to customers while ensuring that the facilities remain on and operational. And so to try to close out here, there's one other slide. I'm not going to go through detail here, but it's the what's coming up. So Tori, if you jump to kind of the next slide, it's just to take away. Nate's talked about the resource adequacy and IRP. He also mentioned early on the storage. We don't have a lot of time to go through that, but out of Surja, we are pursuing the procurement of up to 3 GW worth of energy storage over the next few years. There's the first one is this August for a little over 1 GW across both commented, AMR, and service territories. And so we're really trying to increase the resource mix. And then there's some customer programs we're going to be looking at over the next year. One's geothermal, potentially a storage for all to buttress the Illinois solar for all. So there's lots of additional programs there as well. And it just kind of shows the end to end that we as an agency are really trying to support, and we're enacted through, in this case, recent legislation. And so the last slide is just a takeaway. It's some quick links for all of you. Back to you, Mega. Thanks.
Thank you, Jim. Since we went a bit over time, we may not be able to take questions at the end, but we really truly appreciate our attendees' time and engagement. We will definitely share the slide deck and webinar recording, which will include contact information of our speakers. So if you have any questions, please don't hesitate to follow up with them directly. And I really want to thank all of our wonderful speakers for taking the time to present on this important topic. And thank you to our webinar attendees for joining the session. This webinar wouldn't have been possible without the support of our stakeholders who take keen interest in participating at our webinars. Please stay tuned for an announcement regarding the next Power Hour webinar. Thank you all, and have a lovely weekend.
Great. Thanks all.